Everyone says, well, at heart, I'm a value investor. What's your definition of a true value investor?
I think there are really two elements, or maybe three, to be honest, that distinguish a true value investor. The first is where you look for opportunities. It's just what your orientation is towards finding securities that are likely to do better than the market. Because I think the fundamental fact about investing that nobody can ever forget is that whenever you buy a stock thinking it's going to do well, somebody else is selling it thinking it's going to do badly, and one of you is always wrong. Only in Lake Wobegon can all the managers outperform the market. So you always have to ask the question, why am I on the right side of this trade? And there is a value approach to being on the right side of the trade, and it is now rooted in a lot of work on individual investor psychology. And it is, first, you want to stay away from the lottery ticket stocks. People in every country have always paid for lottery tickets. They've always been crappy investments, and they're paying for the hope and the dream. So you want to stay away from that. Second thing is, like in life as in investing, people are overly averse to what's ugly, disappointing, cheap, and you really want to go there, which is the corollary to staying away from the big upside stocks. And I think the third thing that really value investors are aware of is that human beings are constituted not to think in terms of uncertainty. If they think there are weapons of mass destruction in Iraq, they're sure there are weapons of mass destruction in Iraq. Nobody thinks it's a 60% chance. If they think it's a good stock, they think it's a 100% chance if it's a good stock. If they think it's a bad stock, they think it's a 100% chance it's a bad stock. What that means is that the good stocks are overbought and the bad stocks are oversold. So you want to go where all those factors lead you, which is you want to look for ugly, disappointing, diseased securities where you have a sense that the disease is more than built into the price, which ultimately means cheap. And that's the first thing that distinguishes a value investor. The second thing is that...
So in essence, you're saying emotions are your enemy.
Emotions are absolutely your enemy. You want to be a certain kind of mutant who is just completely different in their orientation to what's an attractive investment for the rest of the market. The second thing is that you want to have, even then, when you come to look at these securities, because some of them are terminally ill, you want to have...
Some of them are really diseased.
Right, are really diseased, and those you want to avoid. So what you want is, you want a better methodology for figuring out what this security is worth, and that's where you go back to Ben Graham and David Dodd. So all the MBAs who are taught to do discounted cash flows, or what is a shorthand for that, ratio, or multiple valuations, have been taught what may be a proper thing in theory, but is for three basic reasons a terrible way to value securities in practice. And the first and most fundamental is that when you do a discounted cash flow, you take weighted averages of near-term cash flows, which are projections, which are very good information, and distant cash flow projections, which is very bad information, and you add it together. And when you add bad information to good information, you wind up with bad information. Secondly, they ignore balance sheets. It's all projected earnings and multiples of earnings. And balance sheets are the most reliable, solid information you have about a company. And the third thing is that if you look at the assumptions that go into a discounted cash flow model, they are profit margins, growth rates far out into the future, costs of capital. Nobody knows what those are for a company like Ford. But there are things you do know about Ford. Is this company going to be economically viable? Probably not. Does Ford have any competitive advantage over the other big global car companies? And the answer is no. So you'd like a methodology that incorporates those kind of assumptions into your valuation. And that's what Graham and Dodd developed. Always start with the assets. Then look at the earnings power and see if it's protected by the assets. And only then, and this is what Buffett taught people to do, look to pay something for growth, because growth is only valuable if the investment in growth earns more than the cost of capital. And if it doesn't, growth can destroy value. Growth is not a valuable thing as a rule.